So, Collin, I was thinking, how do we intro this podcast with John Farber? So this is what I was going to do. When you get a chance to go to John Farber and record a podcast in his home studio, you say yes. When you do it after he just made 79 times his money selling CrownRock to Vicky, you say hell yes, even if you have to take Collin.
I like the radio advertisement voice.
I've been working on that.
No, it was one. I really appreciated getting to spend time with John. I really liked hanging out with him. Just a really interesting guy and a thoughtful guy. And, he thinks about things in an interesting way. And so, going there after the CrownRock acquisition wasn't a bad deal.
Well, the thing I didn't really say on the podcast, but I may have told you kind of on our way up or you're going in, is the thing about Jonathan Farber. I think of kind of like all my peers out there that I was friends with in private equity and stuff. He always seemed to have like a really good grasp on the macro, the big picture. A lot of private equity guys are good with numbers, can get into the details and stuff. But, you heard that in his storytelling. Hey, we had a thesis on this and that.
Yeah.
And, I think
that's what I was saying. He's very thoughtful, and it's not even just on energy macro. I mean, throughout the evening and night, and, some stuff was on the podcast, some stuff wasn't on the podcast, but, he hangs out with interesting people, interesting podcasters, exploring different topics. And so, I guess what I'm getting at is like, he's got a curiosity that he follows and learns about different things, which I find to be unique in the private equity space. Because to your point, most people get stuck in an Excel spreadsheet and they know the numbers, but they don't think about, other things that are happening in the world. So it was definitely an interesting conversation.
So we'll turn it over. Do you think we drop this in two different parts? Because it's an hour and a half.
This is a long podcast. No, I think we drop it in
one.
And I also want to say it's funny because we're sitting there at Jonathan's house, and we're sitting there. He's like, "Oh wait, we're recording a podcast." He's like, "What am I going to talk about?" And
that's typical Farber crap, though. I love him. I always try to get him to
this guy. Like, we could have recorded a 3-hour podcast if we really wanted to. It's like he's got a ton of interesting stories and things to talk about. And so, I think that this was just a banger episode, and I'm excited for it to go out.
It was cool. Everybody, Jonathan Farber of the 79X.
He got fired from Kane. Now we ain't got no shame. So we started a pod, took Yates to town.
Dude, congratulations.
Thank you.
CrownRock.
Oh yeah, that was
a good day at the Farber.
It worked out. Yeah.
So I still think the craziest thing about CrownRock is just how long you held that. Because when did y'all do that deal?
2007.
I mean, that's 17 years. That's like never been done in private equity, right?
Don't get me wrong. There was a lot of pressure to sell that deal at various times. I mean, we had a lot of constituencies, both internally and externally. The tradition, obviously, in our business is if there's a deal that you can sell and make 2.5 times or 3 times your money, there's a lot of people who say you're an idiot for not doing that, right?
Right.
I think you were chief among them in that.
Probably. Any chance I get.
Is that one not working?
That arm's not coming down.
Oh, it's not?
Yeah, I don't want to.
It's too tall for you.
Yeah. I was waiting for the short jokes to come out. Collin can't reach the mic.
Take long.
Yeah, there we go. Shots fired.
But yeah, we had one guy internally, Jay McLelland, our chief investment officer, who got that title largely because of his stubbornness in selling CrownRock, well deserved. He was always, whenever there was a lot of pressure to sell, whenever we had unsolicited offers, whenever there was a hot market environment, one of our direct competitors would sell. He would basically stand up and say, "Look, this is what's going on. These are how many new benches we're going to be adding. These are how many new locations we're likely to add. This is what this thing is going to be worth in the future.
The amount of conviction too, there's a story that Peter Thiel tells about Zuckerberg. They had an offer from like Yahoo to buy Facebook for like $1 billion, and Zuck walked in and it was like a 5-minute meeting, and he's like, 23-year-old kid. He's like, yeah, we're not doing it. And they're like, what do you mean? We need to consider it. And he just had conviction in what the platform could be in the future. And so to hear someone have that conviction on an oil asset is pretty interesting to me, and lay out the case of, hey, we have all these different benches that we're going to be able to extract from. And so kudos to him, because it takes a lot of, it just takes a lot of.
I mean, look, don't get me wrong. The management team was the critical, Tim and his guys were the critical factor in generating, returns on this investment. And without supreme confidence on their side, because I mean, they didn't, they didn't have a lot of wealth outside of this deal, right?
Yeah.
So like you've been in a lot of deals, Chuck. Like, when you start to get into really positive return territory, and the management team starts thinking about how much cash they take off the table in their carry, it becomes really difficult to hold that position.
Well, think about it this way and I'll just make up random numbers because I don't know what your deal was with Tim and his guys, but let's say in the high splits, like at 3 times your money, management gets 50% and the private equity guys get 50%. You're drilling half a well unpromoted at that point if you're in the high splits. And management knows that. They're looking at a $10 million well going, that's $5 million of my dollars. And so that takes real commitment. I mean, that's a little.
What it takes is, I think what it takes is if you're a member of the management team and you've got, $10 million plus in theory that you're looking at if we sell the business, in order to stand up and in order to sit at the boardroom table and basically endorse a long-term hold strategy, you have to have a tremendous amount of confidence in the quality of the asset, right? Yeah. I mean, that's what you're saying. You're saying, look, the discount rate that I'm willing to put on holding the asset is not going to be super high, right? Like, I'm not like I have enough confidence in this in the quality of this asset where it makes sense to hold it, basically. And that's what happened, right? So we got to the end of the fund life in 2017. We were able to put together a acquisition fund to buy the position. We had a very significant amount of our investors who rolled, much more so than normally roll, because we were, we spent a lot of time socializing investors regarding the future potential of the deal.
And when you say that, when you say they in that situation, you're talking CrownRock, i.e. you, the firm, went out and raised the vehicle with investors to either buy out existing investors or you allowed them to roll.
Exactly.
Okay.
Exactly. And we rolled, almost every member of the CrownRock team rolled the entirety of our capital in the deal, which is, again, pretty unusual, and we had a base case estimate, I think, on the roll of we were going to make a little over 2 times our money, because it was a pretty substantially valuable asset at that point. And at the end of the day, we made about 3 times our money on the acquisition fund vehicle.
So I'm loath to praise Mr. Farber because he's going to throw it back in my face. But anyway, I love you like a brother. But
here we go.
To your credit, you didn't get bitched at by LP World when y'all did that. Because I would have heard about it, and you just didn't. And why I'm saying that to the world,
we did when we organized the acquisition fund.
When you organized the acquisition fund, you gave people the option to roll or to be bought out. You didn't get griped at by people, and usually someone's always griping that something was unfair. The GP is screwing us somehow, and you didn't get any of that. So however y'all did it. I think, kudos to y'all.
I'll give you a couple of keys, right? Like we didn't. It's better to be lucky than good in our business, and I think we did some things right, but we also, had some. We were also lucky. We worked hard to come up with a fair valuation on a mark-to-market basis, and then when we went out and solicited secondary interest in buying, pieces of Fund 4 as we rolled it into the Fund 4 acquisition fund, it worked out to be essentially exactly 100 cents on the dollar. So we were able to say to investors, look, here's the deal. you can come out of the fund and get cash, and that's 100 cents on the dollar of what we told you it was worth a few months ago, or you can roll that value, and we were not going to subject you to additional promote going forward. We had a small promote on new money that came in, but we didn't promote, the existing.
Oh, you didn't
investors.
promote
No.
on the GP?
No.
Oh, no wonder you didn't get pitched at.
I mean, it was still a great deal for us because we were able to crystallize the carry that we had earned over the first 10 years of holding the investment and put that in as pari passu investment dollars, right?
Right.
So that was a great
Yeah.
option, and that worked out very well for us. So I don't think we were greedy. We did it appropriately, and I think people responded, to that set of terms.
Yeah, no, I think everybody would say that's fair. Interesting.
John, can we roll it back real quick, and can you explain to us how LimeRock is structured? Because I've got to meet a ton of great people from LimeRock Resources, but you guys have LimeRock, the fund, you have LimeRock Resources, and I think LimeRock, is it New Energy?
New Energy, yeah.
Okay, yeah, can you?
Collin, we have, so LimeRock has been in business since 1998. We're currently investing the LimeRock Partners investment vehicle. We're currently investing Fund 9, which is a $400 million vehicle, and we put.
Is that all oil and gas assets still in the fund?
Yeah.
Okay.
It's oil and gas and oil services.
Got you.
That's been, that was the vehicle that invested with the Crown Quest team in 2007.
Got it.
And we put in ultimately just under $100 million into that deal. Almost all of that capital went in the first couple of years. We had, one of the keys to success in that deal was we were able to sell off some of our developed assets to MLPs kind of relatively early in the life of the investment. We were able to use that capital to both provide, some modest investment return early on, and which probably reduced our appetite or our need to sell the deal early. And it also gave us plenty of early growth capital on an efficient basis because we didn't have to put new equity capital into the deal.
Yeah.
So, so LimeRock Partners has been, kind of our longstanding core investment product. We started a few years after that. We started our LimeRock Resources vehicle, which is run by Eric Mullins and Charlie Adcock in Houston. And that fund is in the business of
Towns is CFO there.
Yeah, Towns is our chief financial officer. That fund is in the business of buying, proven developed reserves and essentially lowering the costs and managing the operation of those assets on an efficient basis. That's been a business where, I mean, I don't know how much of this I'm supposed to say. I can, I'll run this by our corporate counsel. He'll chop this out or maybe not. But there have been some big freaking blowups in that space. This is a business where if you manage it carefully, the way it was sold to people is if you manage it carefully, you generate a low teens type of return with minimal risk. But the way it's turned out is that a number of our competitors took on very aggressive leverage, and your risk goes up when you take on leverage. And if you run into what we would consider to be pretty modest production disappointments, you basically throw away your equity.
Yeah.
And that's what happened. I'm not going to name names, but you guys know who I'm talking about. And that's made it a lot harder to raise capital. I mean, we've pursued the strategy with the appropriate amount of fiscal conservatism, and we've achieved the results that we sort of set out to. But that hasn't been true for the sector as a whole. That's made it more challenging.
Danny Weingast used to always talk about it's like flying a jet airplane 5 feet above the sea. A wave gets you at some point.
I mean, look, that's why you're not supposed to fly at 5 feet, right?
Exactly.
That's the thing. It's like
leverage.
And I'm not. And by the way, I don't mean to denigrate Danny at all. He's not.
We didn't denigrate Danny at all.
No, we did not. We didn't. We will later.
That's section 7.7b 2 little I in the non-disparage agreement. We didn't say a bad word. We didn't say a bad word at all.
Yeah.
Senator.
I have always been amazed by how much leverage this industry takes, whether it's in upstream assets or oil field services, because I just run by this belief that it's much harder to kill a business when you don't have
amount of debt. And so it's a tell old as time in oil and gas, where you have the slightest hiccup in operations or oil prices, and all of a sudden you're upside down and kills your business. So
I mean, it's a killer. It's Tim Dunn has a saying which I'm going to screw up, but well, I won't even try to paraphrase, but basically, the idea is the way you make money in the oil and gas business is by being able to hold your assets through really tough times.
yeah,
And that's so true. And one of the earliest, most formative experiences I had in my career was when I was an investment banker at Goldman. I was a very, very poor investment banker. I don't have the relationship skills needed for that job, and it was not suitable to my personality, such as it is, at all. But I did work on a deal where we sold Belden Blake to a buyout firm. People can look it up if they really care. We were the selling bank. I went out and pitched this firm. They had never done any similar deal like this before. I pitched them and presented an LBO model, which had a very modest amount of leverage on it, on how they should manage this deal. It was a gas play at a time when the gas market, when the U.S. natural gas market was pretty weak, as it has been over almost every year of my career,
pretty much my entire career
in this business. So not an unusual time at all. But basically, they ended up liking the idea, and they bought the company, and they put way more leverage on it than I had recommended. And far be it from them to listen to me. I was just a selling banker. Like, who the fuck cares what they tell you?
Yeah.
We know better. We know how to maximize returns through just levering the shit out of things, and that's what they did. And then 18 months, 24 months later, when the gas market dropped under $1, probably, I don't remember exactly, but it went into the tank. They had to sell off a significant portion of the assets at a very bad time in the business. It turned out that they owned a big position in the Marcellus. So that investment would have been a home run if they had been able to hold it. They were able to get out and I think not lose money at the end of the day. But it was a great example in how leverage really destroyed their ability to generate an excellent investment return on that deal.
Yeah.
And I just see that over and over again in our business. The capital asset theorists will tell you that taking inexpensive leverage from banks is always the right move from a theoretical perspective, but it just feels like the wrong decision in so many anecdotal cases that I'm personally aware of. And conversely, keeping a relatively modest debt profile has served us incredibly well, including on the CrownRock deal. We went through periods of time when oil prices cratered, and rather than focusing and having emergency board meetings to restructure covenants or figure out how to raise emergency capital, we were able to focus on how aggressively should we increase our leasing budget. Who should we talk to about buying additional assets? We really didn't end up making any significant producing property acquisitions into CrownRock, but certainly our leasing program was a key part of the success of the deal.
Yeah.
So when did y'all so you said 07, 08, you started CrownRock.
Mm-hmm.
When did you start getting assets? Because back then, as I recall, it was like, do we like the Sprayberry? Not like the Sprayberry? That was even pre-Wolfberry frac, right?
It was right around the time the Wolfberry
Okay.
was starting to to get popular.
'Cause
But there were still a lot of people who did not think it was going to be an economic play, and it wasn't, right? Like it if you looked at the current well economics, you had to make some pretty aggressive assumptions about technology getting better, recovery rates going up, and costs coming down in order to make a play out of it. And those assumptions came true, right? And everything kept getting better, and then you sort of moved into this mode where I know Chuck will remember this. Collin, you might be too young for this, but there was a time when every oil and gas engineer was trained to think that the current forecast for a well EURs and for costs were always going to be too aggressive. and you needed to be much more conservative than that. And then the shale came into play, and because the technology was so primitive initially, and because it was such a different type of extraction, it turned out that we were able to get better faster than we expected, right? So there was several years where the guys who were historically overly optimistic, the guys who would have been wrong in for most of the history of the oil business, were right. So we moved into this scenario where everyone sort of learned that you're actually going to do better than your forecasts. That was not a long-term lesson that served the industry well, right?
Yeah.
But that became kind of the industry consensus, the feeling, the vibe in our business for a number of years. And I think that kind of happened until, I would say, the 2016, 2017, 2018 timeframe, when we started to see real deceleration and improvement, right? And then that got interrupted by COVID, when we had this massive decline in activity, which actually had the effect of being able to give the industry an opportunity to high grade massively, right? Like at that point, we kind of knew which areas were the really good areas, and the industry as a whole was able to seriously high grade its efforts and drop rigs predominantly in areas that were B and C tier areas.
Yeah.
So then you saw again another spike in per well unit efficiencies resulting from that high grading, and I think we and others have said over the last couple of years we expect that to kind of attenuate and potentially reverse, but that really hasn't happened. I mean, we're now seeing a bunch of companies come out and cut rigs while increasing their production expectations, right? Which is a good thing for those companies and a good thing for capital efficiency overall. But cumulatively, it's having a kind of a concerning effect in terms of overall market dynamics, right?
You know what was wild? So I just spent 2 weeks with Brian Sheffield over in Australia, and 10 hours a day, right? So we had to talk about everything. It was interesting because he started Parsley in about '07, and he started leasing in the Midland Basin and started doing the Wolfberry fracs. And there was a rumor floated out there that Dad, at Pioneer is like giving him the recipe of how it's going to work. Actually, when we talked it through, Pioneer did not think horizontals were going to work. They thought it was drained.
Yeah.
That the Wolfberry downspacing to 80 acres or 40 acres, wherever it went, had drained enough that horizontals weren't going to work. It was actually John Chrisman at Apache that sat down with Brian and was like, no, we're going to drill horizontals. It's going to work. We sold Adventure 2, which was Midland Basin stuff, to RSP, and we got $36,000 an acre, and we hadn't drilled a horizontal. And I remember Mike Hines, because if you modeled it out, it was worth $50,000 or $60,000 an acre. And I remember Mike Hines just looking and going, dude, it might be drained. We should just take this. So, yeah.
I think it's interesting to hear.
It wasn't a no-brainer that all that stuff was going to happen that John just talked about.
Look, one of the other things that made the CrownRock deal work is we started jokingly calling it this, but it actually turned out to be a real phenomenon. We basically said, look, we have a last mover advantage in this area, because we kind of sat there. There was a time when the land situation was pretty competitive, and companies were pretty hard nosed and going after land, and as a result of that, they were very tight lipped about what was happening in the field. But then that changed, right? Like it eventually all the good units got leased up, and people were kind of trading around the margins, and they were blocking up their land, but it wasn't the same in terms of that fierce competitive dynamic. Quite the contrary, that companies increasingly realized that by sharing and pooling information, they could develop best practices in a much faster and more effective way, right? So that's what ended up happening out there, and we were able to participate in a lot of those data swaps and to see what was happening with different wells, and then we were probably I think we definitely were the last major producer in the Northern Midland Basin to drill a horizontal well. I don't think we drilled our first horizontal well until 2014.
Wow.
So we kind of waited a long time.
Yeah.
Yeah, Pioneer and Parsley were late in 2013. when you were talking about the public companies being late to it.
Well, I loved how you framed up or how you told that story about how for once, we could become optimistic in our assumptions. And that was really enabled by technological revolution. But when I started drilling wells in 2010, I was drilling for RSP. Back then, it'd take us 3 weeks to drill an 11,000 foot vertical well. And, Pioneer didn't have a horizontal program. And so that advancement, if you look at from 2010 to 2015, drilling a well looked completely different in a matter of 5 years. And so it's interesting to hear about how y'all saw that transformation and being really pessimistic on assumptions and conservative on that too.
It's kind of, I'm a little puzzled by it. I'm puzzled by what's happening now. I'll be very honest. Like if you name what is something that's happened technologically in the last 12 or 24 months in the field that's a game changer, like, can you think of something?
Not a material step change.
But it's like
I
a
don't
lot of incremental changes in a lot of parts of the drilling process is having this still pretty significant cumulative effect on costs and drilling speeds and whatnot. But it's like not any one single thing that you can point to.
Yeah, it's just compound effect from several different things. Yeah. Yeah, that is interesting. And I was also going to ask you too, just kind of on like current state. I was just in Midland last week or the week before, and all the talk is about consolidation, right? And a lot of engineers are talking about it. And if I study the last, just call it 100 years of the oil and gas industry in the United States, we move through these cycles. We expand, we contract, we expand, we contract. You have a ton of M&A in there, and it's kind of a story old as time. But everyone's like, well, this time's different. How do you guys think about it? From a private equity perspective, with all of these large M&A transactions, do you think that fringe assets start peeling off in the next couple of years, and that opens up opportunity for management teams to go out there and attack those opportunities? Just give me kind of like your overall state of the market. And
what do you tell an investor on how you make money today?
I mean, look, things are pretty cheap, relatively speaking, right? There's this kind of underlying assumption that our industry is going away. Stubbornly, it has not, and doesn't really seem to have much of a predilection to. In terms of sort of general themes, I would say that one challenge is that as more and more efficiency has been sort of ground into drilling fleets. Part of the reason for that is economies of scale. And when Chuck and I were in our heyday, many fucking years ago, you could easily back a company and have a 20 or 30 or 40 million dollar annual drilling budget and generate good returns if you were drilling in a good area with quality people. And it's just,
and that was a relatively big company. Back in the day.
Exactly. Today it's like that type of drilling program is going to be burdened with really profound disadvantages. Just given the sort of industrialized nature of operating rig fleets and frac spreads, and it's changed. It's fundamentally changed, and you need a much bigger drilling budget for it to make sense, which is, I think part of why, taking non-operated positions and plays has become a more popular investment approach. When we started LimeRock in 1998, it had been, I had spent the prior 8 years working as a research analyst at Goldman Sachs, and then 2 years unhappily working as an investment banker before starting LimeRock. And during that time, the businesses, there was a guy already covering the big E&P companies. So when I got promoted in 1992, and they're like, you got to carve your own universe, I picked up a bunch of like small and mid cap US E&P companies and some Canadian E&P companies. Those are the ones that essentially weren't being covered. And these were, run primarily by engineers, and they were really centers of excellence. They would the ones that were successful would pick a play, and they would focus on that play and develop expertise that gave them highly differentiated economics, right? And what I quickly learned was that most of the smaller and medium-sized public companies had big portfolios of non-operated acreage. And those companies sucked because they had no identifiable competitive advantage. And they just, I would compile the finding cost study every year where you basically pour through the annual reports and you'd compile their, different categories of capital expenditures and look at their reserve report, and you'd basically calculate their capital efficiency on finding new reserves. And it just, I just spent many nights at 85 Broad Street tabulating these numbers and getting hammered home that the companies that had that $500 million companies that had positions in 8 basins, most of which were non-operated, would just have shitty numbers every year. And the companies that that focused on Eastern Alberta and developed an expertise in a shallow gas play would just have exceptional numbers. And it became very clear that you had to operate. And that was really the operating philosophy of Lime Rock for most of our history. When we started, that was a core principle, is that we didn't want to be involved in non-operated positions. And then
well, I don't know if it was you were the same way, but if you got somebody's resume and the guy was operated by others, OBO for Apache or one of those places, you're like, God, that's got to be a crappy management team.
Yeah.
I mean, that was
doing really, just signing AFEs.
Yeah.
That's why I've always looked at non-op. There's no competitive advantage to it, right? And then I think this was a few years back, I was talking to this engineer. I can't remember what company he was at, but they had non-op position in Henry's wells. And he's like, we got to check every single month from Henry. Like, they operated the hell out of that asset. And then the month that they sold that asset, capital calls started coming in. And he's like, there was a clear distinction between Henry and whoever bought that asset. So there's all this agency risk involved in it as well. So it's like, you don't have a moat, no competitive advantage. You have agency risk in the operator. And so, non-ops just never made sense to me
but that changed though. Like what happened was in sort of 2015, 2016, we're constantly looking for opportunities to put money to work. And we had been very successful in a deal in the Marcellus with Roger Beemans. And the land team that put the acreage together split off and approached us about backing them in a minerals play. And we had never done minerals. We didn't like minerals. We had an aversion to it because of our sort of DNA aversion to non-op, right?
Yeah.
I mean, minerals is non-op. So we were initially not, but like we knew the guys were very smart and had made us a lot of money in effect.
Yeah.
So we took a hard look, and what we ultimately concluded was that if you were buying acreage in an area where you understood the economics, they were so effectively differentiated from other areas that you knew the wells were going to get drilled. Because your primary risk is that the operator decides not to drill the wells, right? And you just
having a
don't
liquid
monetize.
asset.
This is crazy in the modeling we did at Kane, because I never understood. I mean, Carl Brunsicki is one of my dearest friends on the planet. I still don't understand minerals, but you would rather the well be drilled this year and hit 75% of the type curve than wait for 3 years and have it hit 100% of the type curve. It was
what you're looking for. If you're
but
looking for IRR, If you care more about
if you
ROI,
paid up front for that
Chuck,
opportunity,
your ex-wife knows this better than anyone. The fucking Ferrari dealership does not take IRR.
Like cold hard cash.
Cut that out. Or we gonna?
No, we're leaving. We're leaving
Okay,
that.
all right.
there's another non-disparaging agreement that covers that situation.
I can't say anything, but Farber can.
Have you ever heard that story? This is a great story because we got to get this on tape. So God bless Kim. Kim's a wonderful mother. I am so blessed that our problems did not leave me with a bad mother to my children. So she's amazing, right? And she's cheap. To her credit, she's very cheap and all. And we finally had gotten to the place in life where I'm like, go splurge on yourself. And she wants a Ferrari. Because I mean, she should have been a race car driver.
Yeah.
She wants that. And I go, do me one favor. Will you just call Farber and have him help you? Because left to your own devices, you'll do it cheap and all this. And I don't want to spend this fortune, but I also want you to do it right.
Did you help her with Ferrari?
Oh, man.
Tell the story.
So now we have to go to another part of the story. So I got asked by the IPAA at the private capital conference to talk about all the other private equity firms. And I'm sitting there going, there's no fucking way I can do this. Because if I get up and trash people, you know, these are friends of mine.
Yeah.
I go, but then if I get up there and I say great things about everybody, they're going to call me a pussy, right? Oh, yeah, you will stuff. So anyway, I got up there and I compared every private equity firm to a rock band. And like, I said NGP, they're the Beatles. They really started it. Plus, when they sold half themselves to Barclays, they could talk in a British accent and not sound any more pompous than they already are. So I was doing all that. So put my man Farber up there and I said he was Keith Richards. And I said, because not even, and John did a horrible deal. We're not even going to speak its name. But anyway, did a horrible deal. And I said, not even that could kill him. He's just like Keith Richards. And so anyway, the rumor I heard, and I've been meaning to ask you.
Rumor, okay.
The rumor I've heard is that you had like everybody from Lime Rock together because y'all do y'all's annual strategy session or whatever. And that was right after I'd said that on stage. And you were down there. Chuck Yates has attacked our firm. Chuck has come after me. He's talked bad to me. But don't worry. I'm advising him, his wife on her Ferrari, and I'm fucking the hell out of Chuck Yates. I don't know if you actually said that, but that's funny.
I mean, I can neither confirm or deny that, but it's actually pretty accurate.
Farber looks like he doesn't remember it, but he's like, that's definitely something that I would say. So
now. Yeah, it's all coming back.
Now he's pissed. I think I'm paying.
So it sounds like Kim got the top of the line. Ferrari got the
job. I mean,
well, I mean, she didn't know about it until I told her. So, I mean, it was a beautiful car.
Oh, it was gorgeous.
Hopefully
what was it, a 458?
Hopefully you got to see it a few times when she would pick up or drop off kids.
I drove it once.
You drove it once?
Around the block. That was it.
All right. Well, I hope you enjoyed it.
There you go. Yeah. Oh, well.
When I first...
But you had sort of asked, so look, what I was saying is that was kind of crossing the Rubicon for us in terms of getting back into non-operated stuff, right?
Yeah.
And we soon after we did that deal with the management team I was talking about, which is called San Jacinto team. They're a group of guys based in Denver that do an amazing job for us. We're currently investing our third vehicle with them. The CrownRock guys approached us with a minerals idea, and that's been very successful as well. And like the stuff we've done in minerals has been very, very successful. I think a lot more so than general industry. Our chief counsel is probably not going to let me say this, but it's unquestionably true. We've just done really well on the mineral side, but it's because we've stayed really disciplined. Like we just think that because you don't operate and you don't make the drilling decision, you got to be damn sure that you're getting the right acreage.
Yeah, you got to stay tight.
We just have really, really strict underwriting criteria on the quality of the acreage. So we've turned down a lot of stuff. We never got active really in the Haynesville, which is a big mistake in retrospect. We left a lot of money on the table. Mineral strategies in the Haynesville did very, very well over time.
Yeah.
But look, I'm not complaining. We've done well in that area. It's been by far the most active area that we've invested in at Lime Rock Partners, since 2016. And I think we invested earlier in size with a greater portion of our fund than any of our competitors, and it served us really well.
Yeah.
I would just apply the same to non-operated stuff. And I'd say that's become an important strategy for us because given our fund size, it's not really going to be viable for us to do big, operated programs through our companies, unless we're taking such a small part of the company that it's not something that'd be interesting to us. We want to control the decision-making process.
Yeah. Got you.
So give me a typical deal, and I know there's no such thing as a typical deal today. A management team walks in. Do they have to have an asset for you to back them? What do these deals look like that get you excited, get you to put a term sheet out the door?
I would say, they walking around money deals. I'm not going to say never, because we don't like to draw like hard and fast rules on things. But because we don't think those serve you well. I mean, there's always going to be conditions that make a deal interesting, except in seismic acquisition. That's the one exception to that. No, seriously, we don't. One of our competitors, I remember early on, we when we were first getting going, we studied a number of our competitors and the rules, the investment rules that they were implementing, and one of them had a hard and fast: we're not ever going to do anything in the Gulf of Mexico. And we did get involved in the Gulf. We didn't always do well there, but we did back Mike Manarovic and the Arena team and buying his company out of bankruptcy in the early days of the pandemic. And that was a very unusual deal. And if we had had a hard and fast rule against that, we wouldn't have captured that opportunity. It's been a great transaction for us. But again, going to a federal bankruptcy court and buying a complicated shallow water Gulf of Mexico asset is not something that we had on our bingo card. But
Yeah.
when
How
the
does
pieces come together and it makes sense to do something that's off the beaten path, you got to do it. In our business, it's just not. It's not a business where you can follow a cookie cutter approach for any period of time and be successful. And
Yeah.
the industry has tried. I mean, Chuck remembers that like in the sort of that 2014, 2016 period, everyone thought they had found this formula, this acquisition, this sort of dot map development program, and
It's a
that did not work
manufacturing
out.
process. Yeah.
That shit
Yeah.
didn't work out.
So how does that work for you guys internally, like with this bankruptcy acquisition? Something that it falls outside of your wheelhouse of the normal deal that you do. How does that make y'all feel when you pull the trigger on it? I mean, getting comfortable with a deal like that, just knowing that, hey, this isn't a typical deal
Yeah.
that we do. How do you get comfortable with it?
I mean, you just gotta.
Does it vary that much from the deals that you typically do, or the underwriting process is ultimately the same, where it's like, okay, we
I mean, there are major new elements to the underwriting process. You have to understand the legal ins and outs. You have to understand, the lay of the land in terms of fraudulent conveyance claims, for example, in a deal like that, right? Because you're taking tremendous risk on the front end. And the problem is if someone lodges a fraudulent conveyance claim that gets some traction, then it's like there's this sort of after the fact, reallocation of gains that can happen.
Mhm.
So if that's a substantial risk, you got to know that up front.
Yeah.
So we had to do a lot of work getting smart on kind of legal ins and outs of that type of process, and
Yeah.
ultimately we did get comfortable with it, and the dynamics of the deal met our expectations in terms of certainty and speed of execution. But yeah, there's significant new elements and you just have to be thorough in diligencing
Yeah.
those factors. I don't know. There's no like shortcuts.
Are all y'all's investments U.S. based assets?
Not historically. We've had, offices in Scotland, in London, in Calgary. Right now, it's just, we're just Westport and Houston, with, essentially all of our investment people in Houston.
Yeah.
And that's really, I think, an artifact of the shale revolution. I mean, once the shale revolution got going and we understood there was a large opportunity to deploy capital in the U.S. in an area where you could develop reserves as cheaply as countries that had much higher risk levels, political risk levels. We just didn't think it made sense to be putting a lot of money internationally, and that's very much turned out to be the case. But look, we continue to look in certain international markets. We just deployed some money into the conventional Canadian market for the first time in a number of years. So we're not a U.S. only firm, but certainly that we're kind of we started, and when we started Lime Rock, a majority of our investment was really international. That's changed pretty dramatically.
I have a couple questions for you. Obviously Chuck knows you way better than I do, but you made comments earlier about how you were a shitty investment banker. I want to know your life pre Lime Rock, before starting Lime Rock, your investment banking. Did you get into private equity before starting Lime Rock? What was the reason for starting Lime Rock? How, the why? I want to know the early story.
I mean, I went to Georgetown, studied sort of international relations. Didn't really think much about Wall Street, honestly. It was, it's not a school where you kind of think about Wall Street. It's a school that's a feeder school to the United States Foreign Service. And if you don't go into the U.S. Foreign Service, you usually go to law school, right? And you go on to become a lawyer, which is fine. I don't mean to slam the lawyers that we work with at all.
They're well compensated. They can be slammed.
I bash attorneys all the time. That's what they're paid for.
Yeah. So, I passed the Foreign Service exam. I was supposed to go into the Foreign Service. And I had a lot of friends who had gone in the year before. And I was getting pretty consistent reports from them that it was not a fun place to work. It was a period of time where the Foreign Service was kind of shrinking. They were going through a kind of a bit of a structural change where they were reducing some of the senior level numbers, which meant that they extended the amount of time that you were doing like the super entry level stuff, like stamping visas in a 102 degree, consulate somewhere in
What
Africa.
year are we circa when? This is
1989, 1990.
okay, gotcha.
So I think right around the time Spindletop was discovered, right?
Yeah, exactly.
The early days of the industry.
Yeah, y'all had color TV back
yeah,
then? Yeah.
yeah.
thanks,
So,
guys.
I was getting very negative kind of vibes from people that had gone into the Foreign Service, and I read a book called Liar's Poker, Michael Lewis's kind of zany book about what Wall Street was like. It was not meant as a guide to recruiting people to Wall Street,
But it was.
but it sounded kind of crazy. It sounded like, hey, this is kind of what's the downside of doing this? It's like I'm going to learn a lot. It's going to be fun. I'm going to be exposed to all kinds of crazy people and situations. So I just on a fluke sent my resume in to a bunch of banks, and Goldman had had a research analyst named Don Texter who ran the E&P franchise and research, and he chewed through analysts quite regularly. So this wasn't all that unusual. They had an opening because his assistant had just quit. So they interviewed me and made me an offer. Today, I would never in a million years be hired on Wall Street. I hadn't taken a single finance class at Georgetown. I didn't know anything. I learned everything that I knew about finance, or that I used in finance on the job. They offered me the job. I told you can defer the Foreign Service for up to 2 years. So I got a deferral, and ultimately decided not to do it, and started at Goldman in the energy research group. And that's kind of what happened. I was interested in energy. I mean, energy had, I studied geopolitics at Georgetown. Energy had a very strong geopolitical angle. I joined Goldman right as the as Iraq was invading Kuwait.
Yeah,
it was
Desert
exciting.
Storm era. Yeah,
There was we would be on the morning call. The energy guys would be on the morning call every morning. Morning call is this like firm-wide call to the sales force, and it's kind of a prestigious thing to be on the call, and we were on the call all the time. There was one guy who was kind of Middle Eastern, I guess, and by origin. So everyone at the firm considered him an expert.
Just default expert.
Yeah. So he was like a Middle Eastern expert. He had and he became famous because when the Iraqis started threatening Kuwait, he went on the call and he issued the famous pronouncement: "One Arab country will never invade another Arab country. It's just not going to happen." And that turned out to be wrong.
So your in-house expert.
So who's at Goldman there? Because I would have known some of the corporate finance. I guess Bobby Tudor's there.
Sure.
Eric Mullins is there.
Tudor was
the Riverstone guys.
Tudor was great. That's where I met him. My first experience with Bobby was a classic investment banking services. I don't know. You may want to cut this story out because it's going to be a little inside baseball. But one of the first meetings I got invited to was a meeting where we were talking to an E&P company that very unusually for an E&P company was generating a lot of cash, and they were considering a share buyback. And so we had this pre-meeting where we were all talking about what we were going to say in the meeting, and I had done some research on Exxon's share buyback program, and I had some stats on that, on how it had worked out for them, and that I had come up with, and I kind of deliver my little monologue at the meeting, and the senior bankers are like, yeah, that's good. You should use that in the meeting. So we get to the meeting, and the meeting's proceeding, and it's Bobby's turn to talk, and he fucking does my thing word for word.
He stole it.
He stole it. And it's like, now it's my turn. And I'm like, oh, hi, everyone. I'm
Just going to get an add on to what
Farber,
Bobby
22
said.
years old. I think you guys are great. I don't really have anything to say now. But yeah.
So that's kind of crazy, going back into some energy finance history here. You had a high density of, a lot of smart guys.
There were the
that
two
there.
Riverstone guys that were there.
Was Maynard there during that time?
Yeah, Maynard Holt was there. Didn't you ever?
Maynard was there. Yeah, Maynard.
So did y'all?
Who are the guys
y'all
that ran the
interface?
group? I'm blanking
David
on
Lucian.
Lucian. That's right.
Lucian, yeah.
Yeah.
My favorite Lucian story. Again, I don't, whatever. I'm just gonna tell it. I don't care.
Yeah.
We can
This
cut
is
out
fucking
whatever.
Chuck Yates needs a job. Anything
Yeah,
goes.
exactly.
Anything goes famously.
I'll tell my bashing Goldman story too. I don't know that I've officially.
We haven't even
told
broke out
that.
any whiskey. We're just drinking water over here.
I was down in Houston. We were pitching Joe Foster.
Okay.
When
Newfield.
he was talking about taking Newfield public, right?
Yeah.
And we were pitching them, and it was a little tricky because the company we were taking a business public. There were no real short-lived Gulf of Mexico shallow water producers that were public at the time. There was like Pogo, which was a little different because they had an onshore portfolio, which gave them some length, some greater length to their reserve base. But Newfield had like a 36-month reserve life. It was crazy. So like we were talking about taking them public at 4 times cash flow, or I don't remember the exact numbers, but it was a very low number, but it was arguably a lot more than the company was worth, right? So we go through the pitch. We're at the Sofitel. I don't know if it's still the Sofitel up there, right near the airport. And it was right near Newfield's offices at the time. And we're running through the pitch, and we get to the end, and Texter kind of goes through the discussion of valuation, and he kind of bottom lines what our projected range is going to be. And Lucian like stops the meeting. He's like, no, we gotta move it up 1 full multiple point or whatever,
Yeah.
right? We gotta, otherwise we gotta move it up. And Texter gets pissed off, and he goes, David, I'm not your whore. And Lucian looks at him, and he goes, Don, you're either going to be a hoe or we're going to be a co.
That's epic.
Oh,
That's the way the business was done. Probably still is, but far be it from me to say.
Yeah.
Yeah.
I mean, the guys back at Stevens, the corporate finance guys used to write the research reports and hand it to the research guy. I swear to God. Yeah,
It wasn't that bad.
it was because I wrote one.
No, I mean at Goldman. It may have been that bad at Stevens.
Yeah.
So at Goldman, with Bobby being there, Maynard, I mean, I don't come from the investment banking world. I mean, did you guys interface a lot?
Oh, yeah.
So
There was no control room. There were no fucking Chinese walls, really. Like we talked about Chinese walls, but it was kind of a theoretical construct at the time. It was like on Star Trek, the only time they ever talked about the prime directive not to interfere with other civilizations is when they're about to massively interfere with another civilization, right? It was the same thing at Goldman. Whenever we talked about a Chinese wall, it's because we were doing something that totally violated. I'm just going to need to make sure the statute of limitations has expired on all this stuff before this podcast gets released. But yeah, that was basically the deal.
No, I just think it's cool how, a lot of the top dogs in energy finance now just there was
high great. I mean, for a young kid like myself, it was a fucking dream job because because these companies were terrible investors, right? They consumed capital like crazy.
Yeah.
So they were always in the debt markets. They were always in the equity markets, which meant that there was you always had investment bankers banging down your door, wanting to understand what was happening. You're always involved in pitches, so it was super exciting. It was like a really dynamic place to be as a research analyst.
Yeah,
it's like like if you had been covering like consumer products companies, which are actually good companies to invest in and generate cash and like return it to their investors. that would be fucking boring because you'd never see an investment banker. There's like nothing, there's nothing to do really with those businesses.
Yeah.
So, you know, it's just, it's kind of funny. It's like the worse the actual business, the better it is to be, you know, a research analyst, in a sense, kind of covering those businesses.
So how many years were you in investment banking?
I did that for 5 years. So
Okay.
I joined Goldman in 1990, and in 1995, I left to join a buy side firm, a family office, the
Okay.
Ziff Brothers.
Okay.
And I was only there for 9 months. They hired me to do private energy deals, but then when I would actually find a deal and write a memo and propose it, they would invariably say that they didn't want to do it. I guess I need to be careful. There's a non-disparagement clause there too. Chuck.
That's
Why is it that our careers are peppered with
Yes.
non-disparagement clauses?
I don't
What
have
does that say about us?
I don't have a single non-disparagement clause.
Yeah, exactly. What are you doing wrong?
Man, you guys are shackled down.
It's because we didn't have memes back in our day.
That's
If we'd
right,
had
yeah.
memes, we'd have been fine. Yeah.
Yeah.
So I was there for 9 months. Then I went back to Goldman. That's when I got hired in the investment banking side. It was fun. It wasn't what I wanted to do.
Yeah.
I was really interested at that point in the private equity side. There was really only First Reserve and Natural Gas Partners at that point in time.
Yeah.
I talked to both of them. Neither of them would hire me. So I was like, if I want to do this, I got to start my own fucking place.
That's fucking awesome. I
Um,
love that.
so-
It won't hire you, so you just start your own.
Basically what
shop.
happened. I mean,
Love
that's
it.
it's a funny way to put it, but it's essentially accurate.
Yeah.
And
So
was
how
able-
did you go about doing that?
Well, I was able to there was a group of people who had left Goldman to form an entity called the Beacon Group in 1996, I think.
Rich Obby.
Yeah,
Who all was it?
Bobby, Brian Martin were the guys that I knew.
Yeah.
And they were able to raise like $1 billion, and they didn't have a lot of clear ideas on how they were going to invest the capital. And I was able to basically say, look, you know, that we see opportunities. You know, I had sort of developed this thesis at Goldman that these, you know, single basin focused, you know, excellent engineering oriented companies could generate superior value, right? And I thought, you know, we saw that happening initially in a bunch of U.S. onshore basins, and then it was starting to happen in the offshore with Newfield and others. It was there in early days starting to happen in the North Sea. It didn't really happen on a large scale in the North Sea the way that I thought it would, because the challenges technically were massive, right? But there were other international basins. It was happening in Canada. So we were in, you know, John Reynolds, who became my partner at Goldman, was the oil service analyst at Goldman. And he also had developed a thesis that you could deploy capital into kind of up and coming oil service companies, technology specialists, that would ultimately be very interesting to the large global oil service companies. And we were able to put a pretty compelling pitch together for Beacon, and they ultimately agreed to seed us with $100 million and kind of split the profit interest on that money. So that was our first fund.
That's awesome.
We left, and you know, we were quite young. It would have been very hard to raise a normal way institutional fund at that point.
Yeah. So I was kind of piecing together the timeline and said, you know, you're pretty young at that point. You had to be what, young 30s when you?
I was 30.
Yeah, 30.
Yeah.
Yep. Yep. So
John was a little younger, even though he looks older. It's crazy. But yeah, and our first fund worked out well. You know, we had our first investment ever was Deer Creek Energy. We were able to, you know, British Petroleum, BP Canada owned Oil Sands Lease 24, which is this big lease along the Athabasca River, just loaded with tar sand, and but it was not largely on the surface, so there was no path to development at the time.
yeah.
And there was a management team that had developed an idea to basically drill a radial series of large diameter wells around a single well where you'd put a high capacity pump. You'd pump steam through the radial wells which would mobilize bitumen into those wells, which would drain into the central well, and you'd pump it to surface. Never fucking worked. It was like we spent years trying to get that shit to work. It did not work. It never worked.
I was like really surprised that y'all were doing that, because I mean that's huge technological risk in doing that.
There was a big technological risk. I mean, look, a big part of the deal was the option value of buying that lease. So like we were able to convince BP Canada, because they just didn't want to have that thing on their books. I mean, so much of the success of energy private equity, especially in the early days, was kind of driven by irrational decision making at large majors. You know, I guess that's probably a reasonable thing to say right now. And they just want it off their books. So we basically bought an option on this lease that contained billions of barrels of oil, and we paid them $5 million for it.
Yeah.
You know, 3 years later, when you know, when we sold, we ultimately held that position, I think, for 6 or 7 years, and we ultimately exercised the option. So we own the lease, we, you know, but at that point, oil prices had run up a lot. When we bought the lease, oil prices were under $20 a barrel. So that was why, you know, BP Canada placed so little value on it. And look, that was in our initial underwriting case. We knew that even if that technology didn't work. I mean, look, don't get me wrong. We expected that we'd be able to make the technology work, because we were kind of young and stupid at the time. But even if it didn't work, we figured there was some option value in the lease, and that turned out to be the case.
Yeah. So it's pretty asymmetric from that perspective.
Exactly.
Yeah.
It's a highly asymmetric deal. It was, you know, what a professional poker player would say, a very high expected value bet.
Were you a poker player? The reason I ask is if you Google your name, a poker picture comes
Really?
up. Yeah.
I mean, I did play in the World Series of Poker
Okay.
for a few years. Yeah.
Picture of you playing poker comes up. So
Yeah. I haven't. Poker's something. Do you play poker?
I don't. I mean, I will, but I'm not a great player.
It's kind of like something where you have to play a certain amount every year to stay current in like the style that people are using.
That's interesting.
And if you don't, it's not very fun to play, because you're just in this sort of defensive crouch the whole time.
Yeah.
Which
I've never played enough to gain the skill to be good at it. And so, which is interesting. This research report just came out like 2 months ago talking about the power laws in poker, and they did a ton of data analysis on it. And that's actually got me interested in playing, because now that I have some insight into how power laws play into poker, I'm like, okay, maybe I am interested in playing. But to hear that the skill changes over time.
It does. So I played, there was a couple of years where I was playing a lot of poker, and I went out to the World Series of Poker, and it was fun. I never won any money, but I did get really close one year to getting into the money. And I played with some of the sort of legendary poker players. That was a lot of fun. It was a good time. The last year I played, I hadn't really played a lot of poker during the year, and it just wasn't very enjoyable. So I don't know. I don't know if I'll ever get back to a time when I just have other kind of priorities in terms of how to spend my time. It's very time consuming.
Yeah.
To sit there at poker.
You know what's funny is this is completely off topic, but when daily fantasy sports came out, I used to play 40, 50 hours a week. I had all of these analytics I'd run, and would type up, scripts to upload hundreds of lineups, and I'd run algorithms to pick my lineups. And all the guys in that space were professional poker players, because it had such similarities to playing poker. And in the same vein, it would change over time. And over time, it got to where I was like, I don't enjoy this process anymore. And it was one of those things where it's like you had to spend 40 hours a week doing it to stay current. And I was like, there's better ways to spend my time building businesses. And so
back before the internet, I used to kick all my friends' asses in fantasy football, because I would get on the phone and befriend the local sports writer and
get
the
beat writer.
So yeah. And I'd call him up, and like the guy in Buffalo turned me on to Doug Flutie one year. No, Flutie's going to start. So I was so good at it and all that. And then the internet pops up and all that, and I'm bemoaning this. And my buddy Fish sits there and he goes, let's be real, dude. Our interests have changed in life. If we were playing blonde country music singer, you'd kick all our asses. Fair enough.
Yeah.
In efficient markets, certain
just not as fun.
Yeah, exactly.
You need an information arbitrage to have fun.
I mean,
100%.
informational advantage is really fucking.
That's
cool.
actually, yeah. I mean, when it comes down to like what daily fantasy sports was, it was fun when, I mean, we were all just sharking people. And then once all of these data platforms and content websites came out, it just became less fun because there was too much information out there. So
One final thing to hit on, because I definitely have decided I need a glass of wine or
wrapping
booze.
up already. We've only been going on for like an hour and a half.
Yeah, exactly. Tell us about LP World. What's kind of the latest, greatest? What are LPs thinking? Is money coming back? Give us the lay of the land there.
I mean, I think the source of capital for upstream energy, investment funds has changed fundamentally. We have Lime Rock has always been very endowment heavy. We got our start as part of the Beacon portfolio. We had developed like a personal affinity with a lot of the guys who were, and women who were very who were very plugged into energy on the endowment side of the world. And in fact, CrownRock was very well was largely capitalized with endowment capital. Some of the positions that were in CrownRock on the part of endowments represented 2 or even 3% of the entirety of the endowment.
Yeah.
So there were some institutions that got checks earlier this week representing several percentage points of the value of the endowment, which is interesting.
Oh,
Not a
by the-
normal
heads,
situation.
yeah.
Hold on. Not related, but sort of related. There's a huge disturbance in the force. Sarah Yates had gotten into UNC, UVA, and Rice. She chose Rice. Dad was ecstatic 2 weeks ago. Vandy called and said, "You're off the waiting list," and now Dad's going to have to go to Nashville instead of West U.
Wow.
Sarah broke my heart.
Too bad.
But anyway, keep going. I didn't mean to cut
We
you.
have a alumni, Jeff Schofield, at Lime Rock, who went to Vanderbilt. So I don't recommend it.
Yeah.
reason.
That's awesome.
Chuck's
But,
in us
so-
in that
So
clip.
if there's any way to change that, I would
Yeah.
caution.
There's
I
not
would
a lot of-
urge you to do so.
She had her speech ready to go on, "Dad, here's why I'm going to Vanderbilt, blah, blah, blah." And my line was, "Hey, sweetie, I get it. I wouldn't want to live a mile from your mother either."
That's good.
Yeah.
I mean,
No, but keep going back to
So
LP
look,
World.
yeah, I mean,
May or may not
like-
have been one of those institutions getting the check.
yeah, I mean,
Yeah,
so
Rice did
it's
well. And as an alum, I am grateful.
So like when I take a look down the list of institutions getting very large checks from CrownRock, and I look at investors in Fund 9, very little overlap there, which is kind of sad actually, right? It's like some of these, and I don't blame the individuals that we're working with at all. Like they understand that that we live in a world where 78% of our primary energy still comes from hydrocarbons. And is going to for a very, very long time. That's moving down, modestly, and that there are responsible and irresponsible ways to develop hydrocarbons, and we are very much on the first part of that equation. So I don't make any apologies for the benefits that hydrocarbons have brought into the world. I think the divestment movement is deeply wrong-headed, because it is leading to a world. I like to do these segueing here a little bit, but I like to do these discussion salons here where we bring in kind of interesting intellectuals and expose them to a group of 50 or 75 really interesting people, and it leads to great discussions. We had Steven Pinker here a few weeks ago, the Harvard professor who has done a lot of work documenting the progress of kind of human quality of life, right? Like he has these metrics that he uses, 15, I think, primary metrics that kind of document where we are as a species. And, there's been tremendous progress in almost every one of those metrics over the last 15 or 20 years. It kind of falsifies the notion that we're in this like time of trouble, like which is kind of, I think, largely a product of kind of our clickbaity, social media driven online existence, right? It's like in measurable way after measurable way, life is as good as it's ever been. And when you go down when you go down that list of metrics, whether it's infant mortality or food, access to food, access to transportation,
you have to walk to get water.
yeah, I mean, basic shit like that. These are all heavily related to the cost and availability of energy.
Yeah.
And if you reduce availability of a most efficient form of energy, which is hydrocarbons, people are going to suffer, and they're going to suffer in not inconsiderable ways. And yeah, certainly I am not sitting here saying that global warming is imaginary. It is a real issue. It is really happening, and it is, in my view, anthropogenic in nature. But there is no evidence that there's this cataclysmic snowball effect that's going to send things out of control. Quite the contrary, it seems to be the case. So, we're talking about changes in temperature that are in all likelihood easily adaptable, and yet people want to accept these calamitous reductions in availability of energy instead of experiencing the alternative. Look, I mean, I've sort of segued into a little bit of a TED talk there, but
I'm gonna send you these charts that you'll appreciate. This guy he's an indie hacker on Twitter, and I follow him, and he lives all around the world. And he was making this case for the productivity of humans being correlated with air conditioning. And he's like, I realized this when I was working in Bali. He's like, we'd be outside all day, and out at the beach, hanging out outside. And the second I would walk into a cafe, he's like, I would snap out of this. He's like, I'd be zoned out, and all of a sudden I'm in the zone when I get in this cafe. He's like, it was the air conditioning. And he started posting all these charts of air conditioning in Europe and how not having access to air conditioning lowers productivity of humans, which is, I mean, it's just simple biology. When we're in our state of being cooled, like we can think, and we're not thinking about survival. We're thinking about, being productive as humans. And so you'll appreciate that, because it kind of piggybacks off of just all the other benefits that
I've started giving a speech where I go, guess the temperature in here. What's the temperature in the room? And you get the audience to kind of guess. And then you say, okay, how many people think it's higher than that, think it's lower than that? And then you also ask the question, what was the temperature when you got up this morning? What is it peak during the day? And then, you do, what's the temperature in the peak of winter versus the peak of summer? And what you find is most of the time the room is off 2 or 3 degrees. People, think it's 72 and it's 70 or something like that. And then during the day, you can go anywhere from, high 50s to mid 80s if you're in a Colorado mountain town.
Yeah.
And then, you can, winter to summer is huge. It's
huge variance.
We're talking about way bigger differences during the day than we're talking about average temperatures over the last 150 years. So just keep that in perspective.
No, it's
just keep that in perspective.
No, I mean, look, the where I was trying to go with this is I feel like the the sort of attempt to make energy investing or hydrocarbon investing socially unacceptable is just really wrongheaded.
It hurts people.
It's not constructive. I definitely feel like there is some rationale for policy choices that emphasize less carbon intensive modes of energy generation, whether it be nuclear or solar or whatever. I'm not opposed to that, but the overall policy and it's just frustrated me because I think that our more sophisticated investors understand that, but they've been given politically dictated constraints that are just not.
They're just bound
objectively
by
good.
that.
Are we seeing LP base break down red state, blue state?
To some degree, yeah.
Yeah.
I mean, look, where I was going with this is our core relationships and our the kind of legacy backers that we have are primarily endowments. And, over the last 4 or 5 years, 6 years, those have been taken off the board as a source of capital. So it's been a challenging environment for us because in a market that is transitioning, where a lot of firms are no longer in the business. I mean, the overall amount of equity capital available to upstream energy funds over the last 10 to 12 years is probably down by 70%.
Yeah.
In terms of whether you want to look at sort of current dry powder or any other metric. I think that's the order of magnitude.
Yeah.
And
Eric, I think Eric told me, and I'm making these numbers up, but the magnitude was right. He said there used to be 5,500 people that would invest in energy, and now it's 1,500. To your
that
point.
matches it.
To your
Yeah,
point.
That matches it. I mean,
Yeah.
I'm more focused on kind of the amount of capital.
Right.
But it's like forging new relationships in that environment is challenging. It's, obviously attracting in foreign capital is challenging for us because of, FERPTA and other specific tax inefficiencies that accrue to investors in our space who are not American.
Yeah.
So one last question on that topic, and the tech side. It's funny. I was at a
But can I just conclude
Yeah,
quickly, Colin?
yeah.
I mean, but look, there's other investors who've stepped in. I think more savvy kind of family offices, certain of the state pension funds, the ones, as you say, in the red states have kind of stepped in. And I think expected returns, maybe this is the part I can't say. We'll see what Anu says about this. But I feel like given the reduced amount of capital, both from private equity as well as other sources, expected returns in the space, I think, are going to be excellent over the next 5 to 10 years. I personally have, certainly helped by my CrownRock proceeds.
Yeah.
I have very significantly increased my own participation in the funds, and I feel very, very comfortable.
Yeah.
Past performance is no guarantee of future performance. Blah,
Chuck
blah,
will
blah,
read
blah,
all your
blah.
disclosures
There we
for
go.
you.
Yes.
All right.
So
Investors can lose money, but they
Yes.
can also make money. A lot of money.
So my question to you was, we saw this huge secular swing in and how investors think about oil and gas, which led to this massive divestment from endowment funds. And the story I was going to say was I was, with a VC this morning here in New York, and I met with them back in 2020, and they're like, "Hey, Collin, we love what you're working on. We're bullish on it, but oil and gas, it's just dead." And you couldn't blame them. I mean, it was negative $40 oil when I was talking to them, right? And now, I talk to them and they're really interested in what we're doing. And I look at Silicon Valley, with the rise of high performance computing, they want to go the nuclear route. They're understanding, and I'm a huge nuclear fan, but they're understanding that there's a lot of regulatory burdens and limitations. It's not as dispatchable as nat gas power is. And so I think Silicon Valley is starting to get black pilled in understanding, oh, hey, we need natural gas if we want to power up all of these data centers. And so,
you would think so, but let me give you a sort of counterfactual to that. We recorded a podcast here 2 nights ago, and it was I'm not going to name the group, but it was like a really smart technologist. It was a San Francisco area based podcast that recorded over here because they were interviewing.
Is it Mark Andreessen? That's my man. Okay. All right.
Not anyone.
I was going to be pissed if you didn't. I was going to be pissed if you didn't have me over when Andreessen shows. Keep going.
It was a super smart guy who lives here, who has been at Apple for many years, and is like, he just gave a really compelling talk about how simulation technology has made building things. It's like everyone, all the smart people over the last 20 or 30 years become software engineers, because in the software realm, you can kind of build things and deploy them super quickly.
Yeah.
And you get that immediate feedback and satisfaction.
bits are
And
much easier than atoms.
Exactly. And we're starting to get to a point now where our simulation of the physical world is so damn good and quick and accurate that we can build things much, much more effectively than we have in the past, right? Like all these fucking rocket ships that Musk is building and other rocket ship companies. It's like, this is all, you could find yourself wondering why is all this stuff happening now? And it's largely because we can now build something that we are far, far more certain is going to work as intended than we could
previously. And building multiple iterations of physical objects is really fucking hard and
Yeah,
expensive and
expensive.
time consuming.
Yeah.
So if you can build it right the first time, or pretty close to right the first time, it completely changes the dynamics of that. And, that led to a discussion of AI, and it led him into a discussion of how much, memory, how much computing capacity is going to increase over the next couple of years. And, I need to kind of go back and listen to the podcast to get these numbers right. But I think he was saying that like over the next 2 to 3 years, the amount of computing capacity in the world is going to triple and quadruple, and then sort of exponentially increase from there, which even with more efficient computing units leads to massive increases in energy demand. And he was talking about meeting that through nuclear. And there is a wild mismatch between what he was saying in terms of the timing of the needs and when that energy could be delivered. I mean, nuclear, I am all for nuclear. I think it's, there's a study that came out last week estimating that I think there's been 4 million man years of life lost because of the Chernobyl disaster, not because of radiation specifically released at Chernobyl, but because of the dissuasion effect that accident had on construction of nuclear facilities, and how much air pollution and other undesirable elements, have impacted human health as a result of that. It's very tragic. So look, I'm a big believer in nuclear, and I think, the new designs, I'm convinced, are a lot, are maybe not 100% safe, but a hell of a lot safer than they've been in the past. But look, I mean, the timing is, I think people's understanding and expectations on timing are way off.
But that's exactly what I was saying though. Like I was talking to Founders Fund, and they're like, we're bullish on natural gas and natural gas technologies to fulfill that demand.
It should be
high performance computing. So,
well, I think what tech's not burdened with is tech has so much pull with the government. They may not have the same regulatory burden we as energy people have when it comes to nukes. That's the one wild card that I haven't been able to get my head totally around, because we've seen that big pharma and tech can walk into DC and get what they want.
Yeah.
And so if they have the nuclear solution, potentially the regulatory burden won't be as bad.
We need to record a separate podcast sometime talking about the convergence of tech and energy, because this is something that I'm really passionate about. But what I think is just hilarious is that the rise of nuclear is actually going to enable the rise of synthetic hydrocarbons, where we can use cheap heat to dissociate molecules from CO2 and make high density fuels. And so we'll actually use hydrocarbons for the rest of mankind, and they'll be synthetic. We'll make them in a lab environment.
Yeah, no, I mean, that's
so
absolutely. I mean, it's
what I was getting to all that about was, do you think that pendulum from a secular viewpoint on hydrocarbons swings back? Because I think I'm seeing it in Silicon Valley and in tech. Do you think that comes back to Wall Street and the financial world, where it becomes acceptable? And I also think that it was easy to divest when oil and gas wasn't making any money. And so do you think that pendulum swings back?
I think it's going to have to be repackaged. People aren't going to, I just think it's hard within a 10-year period for people to say, yeah, this is bad, we're not going to invest in this anymore. And then a few years later say, you know what, we were kind of wrong about this. We're going to, that's a very hard thing to get people to do. Yeah. But if you can repackage it in a way where you're doing equivalent investing, but you're calling it something else, whether this is now infrastructure, or this is now whatever, it's something different. It's a power project, but you're like reallocating the type of assets that are there, then I think that's how you're going to get more capital. Kind of flowing into those pockets.
Repackaging it.
Yeah. I still think it comes down to a CIO has to be able to become a former CIO if they don't have energy exposure. And when you're messing around at kind of 5% of the S&P 500, that's still tough. I think that's going to be the big thing we're going to have to get over is being meaningful.
Yeah.
Even if you're the number one performing asset class. But
makes sense.
Unfortunately, that means we have to root for tech to suck, but I don't want to do that.
I mean, this guy, the guy who was here the other night, this technologist I was telling you, someone asked him like, what would be your top recommendation in terms of telling your kids what to study right now, and he didn't really have to think hard. He said, I think it's all about energy, specifically, I think batteries, like battery technology. The advances in battery technology are going to have a profound effect on progression of kind of human society over the next, 20 to 50 years. And that's kind of the tip of the spear right now. So that's what I thought that was an interesting answer.
Tell my kids electrical engineering and finance. Always regret that I wasn't a finance bro like you guys. It seems like it turns out well for a lot of people to get into it, but electrical engineering, and that kind of plays into batteries as well and material sciences. So I agree with his answer. That was good.
Drink time.
Let's
Dude,
get some drinks.
You know what? Before we got on here, Farber said he had nothing to talk about.
I know. What are we even going to talk
It was
about?
all just bullshit. Anyway,
That was good stuff, man.
that was fun.
Yeah.
No, that was a blast. We'll see if it out downloads Gary's podcast.
So do you still need a job, or is this like, are you locked in now to the whole podcast thing? Because we might have to change the name of the show.
If we're doing poker, I'm pretty pot committed on digital lottery. Right now. This was great. So we were talking about something the other day, because daughter Sarah, the one going to Vandy, will run the world one day. We don't know if for good or for evil, but we know she'll run the world. So we're going through things, and I was talking about cutting another check into digital lottery, and she looked at me and said, "Please, Dad, just let me get through Vanderbilt." I was like,
The amount of anxiety that you gave her.
yes. So
Good stuff.
cool.
All right.
Thanks,
Appreciate it,
guys.
man. Thank you.